Hi everyone, thank you for joining us today. My name is Jiaxuan from Syfe's advisory team, and I will be the moderator for today's session. Joining us today is our head of investment advisory, Ritesh, as well as Richard from WealthEnjoy. So Richard is the co-founder of WealthEnjoy, and he also helps to manage several investor and trader communities, including Online Traders Club, YouSavvy, and Singapore Quant Club. He considers himself as an aspiring quant who is always a student of the market. And today we have the pleasure of having both of them to share with us what are some of the common pitfalls that investors usually make and how to actually avoid them. So feel free to raise any questions along the way via the Q&A box below, and we'll be taking some pauses during the presentation to address them. Without further ado, let me now hand this over to Richard from WealthEnjoy, who will be, sharing with us. Over to you, Richard.
Thank you, Jiaxuan. Hello, everyone. Hello, Ritesh, and good evening. I trust that all of you had your dinner already, and it's my pleasure to share with you a few things that a few mistakes that I have made along the way as a trader, as an investor, for your reference, and hopefully you will help you along your journey to become an aspiring investor and trader. Okay, by no means is it exhaustive, but I hope that these few are the ones that really hit me quite strongly along my journey. All right, so let me just begin. Like what Jiaxuan has said, I am one of the co-founder of WealthEnjoy, where over the years, my partner and I, we will collate wealth building, education, and opportunities under one roof. So if you want to find out more about what we do, so please join our Telegram channel at WealthEnjoy. Okay, so today's topic that I'd like to share with you is are the several mistakes that are to avoid when investing. And these, I consider them as cardinal sins. So please, I mean, it's also a good reminder to myself when I prepare this presentation to not make these same mistakes along as I continue this journey as a trader and as an investor. Okay, so the first mistake that I feel that investors must avoid is to chase shiny objects. Okay, so we're not talking about gold or silver or rubies here. We are talking about stuff like this. Okay, so you may recognize this earlier part in the year. And so what's a shiny object? It is probably something that moves on the market that goes up by a lot within a short period of time. Like for example, this particular US traded stock went up by 100% in just 2 days, and the whole world came a buzz talking about it, right? And then people FOMO, go in, show diamond hand and all kinds of hands to try to capture this shiny object. All right, so what happens after doubling in price in just 2 days? Okay, so this happens. In about a week later, it went up by 775%. This shiny object has gone to the moon. All right, so it makes that 100% earlier dwarfed in comparison. So more FOMO, more news coverage is given to this stock. So what happens after that? Did it go by another doubling or 100% or 1000%? Unfortunately, no. Okay, several weeks following that, it came crashing down by 88%. Now, this is not crypto, okay? This is a stock. So what am I talking about here is, okay. Now, when we see moves like this, there is a strong emotional urge, in my opinion, when I was seeing it unfolding, to want to chase, want to try to get it, because it's like a once in a lifetime opportunity. But the question that I asked myself back then is, how easy is it for me to make 10%, 25%, 40% of the move that the shiny object has made? How about capturing another 100%, 400%, or 900% of that move? So when I ask myself this question, I find that I cannot give a definite answer. So as a result of that, I suppressed my urge and did not participate, and therefore miss out on the whole up as well as down. Now, why is it important that we ask ourselves this question? How can we make 10%, 25%, 40%, or 100%, or 400%, or 900% from investing or trading? Why do we need to ask ourselves this question? Because we need to compare how easy it is to make it, so that we can appreciate this next slide that I'll share with you. Okay, with this next slide, this table is what I like to call the loss recovery table. Now, to try to capture the greed of the upside of any moves is always very nice. But to suffer and go through the drawdown or the losses is not so nice, right? So when I look back at my trading and investing journey, there are times when my portfolio has dropped. There are times where certain trades have gone bad. So that is what we call by drawdown or loss, right? From a peak to the trough of your equity curve. So do you know how much you need to make back when you have a 10% loss in your portfolio? So I know we are not interacting here yet. So let's just throw out some numbers here. Very simply, if we have a 10% loss in our portfolio, we need to make 11% to go back to zero, go back to square one. Now, it doesn't sound that difficult because it's like one-to-one. Oftentimes in trading, we are going for one-to-one, at least one-to-one win reward ratio, right? So it's not so difficult to earn it back. Now, if we have a 20% loss in our portfolio, we will need to earn back 25% in order to break even, go back to square one, right? So it's tougher, but it's still achievable. However, when our loss in our portfolio goes down to 30%, the number is not so simple already. We need to earn 43% back in order to go back to zero. Now, if you look at your trading or your investing career or your journey, how are you going to make back 10%, 11%, 25%, or 45% if you sustain a 10, 20, 30% loss in your portfolio, right? So that's a very important question I was asking myself. So as we go down the numbers, you'll see that if we have a 40% loss in our portfolio, we need to make back 67%. And if we suffer half, if our portfolio is half, we need to make back double what we have left in order to go back to zero. Now, how many opportunities and trades do you know of that can bring your portfolio back to double your portfolio by 100%? It's actually very, very tough. Okay, from my experience. If you know better way, safer way, but please let me know. So let's say if our portfolio were to go down even further, 60% or 70%, the numbers are getting kind of high already. It's very difficult, okay, to achieve this kind of a return. Even Warren Buffett is not getting this kind of return. He is probably getting like 25% kind of return over a long term, right? So that is achievable. But to get 100%, 150%, 200% return, it is very, very difficult. The kind of risk that you probably need to take will be a lot higher. So if we ever suffer a 80% or 90% loss in our portfolio, wow, it's harder than getting to the moon already. We need to make back 400% or even 900% in order to get back to zero. Not even talking about profit. So I always put this table in front of me to remind myself, whatever shiny object that I see, how much risk do I need to take? How much loss is it likely it might cost me? And if the potential loss is very high, I will look at the green column and say, I can't achieve that kind of numbers in normal trading and investing, so I better not touch. So that's how I stop myself from chasing shiny objects. All right. So coming back to this shiny object that I was talking about, it had over a span of, this is like almost 1 month. This saga lasted almost a month. There is a 80. Now, for those who are chasing this shiny object up to the highest peak, has suffered an 88% loss. Okay. So how much do you think they need to make back in order to go back to zero, right? The table is put there. The model answer is there already. They need to make back at least 400%, 4 times. Now, is it easy for typical retail traders to do that? Even the professionals are not able to achieve that. So if there is no fundamental good reasons for this shiny object to make that kind of gains, and if you do not have a way to earn that kind of returns like 400%, 900%, then my suggestion is that we don't touch these shiny objects. Okay, just my opinion. All right, so let me move on. So that shiny object is none other than GameStop. So if you have not heard of this stock, please Google it and you can read all about this saga that happened in the past, in that month, earlier part this year. Now, are there other shiny objects in the market? The answer is yes. There's another one called AMC. So if you Google that, you also find out what happened to them in terms of the stock price up as well as down. And the next one needs no introduction, right? This cute little dog, and of course the billionaire behind carrying him up. And this is also another shiny object that those people who believe in crypto and also believe in Elon Musk may have chased. And it was really tempting, really very, very tempting. But I've decided to sit it out as well. And of course, miss out on the gains as well as the potential loss. All right, so these are the shiny objects. Okay, so I hope that this loss recovery table is something that you can take a screenshot of or revisit this video so that whenever there's a shiny object that come across your table, you look at this and see whether you want to take the risk or not. Okay. So the next mistake that I felt that investors should avoid is that they did not diversify enough. Okay, so what do I mean by that? Now, since young, we have always learned this saying that says, what is this? A basket of eggs, right? So we should not put all our eggs in one basket. So this goes for investing and trading as well. So what do I mean by that? Now, the next slide, you're going to see some names that probably are familiar to you. Some are local, some are international. Now, all these are big names, once upon a time shining stars in their own respective domains. However, if we look at the stock price, then it may tell a very different story. If you put all your eggs in one of these companies, then, or several of these companies, then I guess all the eggs are in one basket. All right, so let's take a quick look. For Enron, what happened is that the stock have lost 100%. Okay, so when a stock lost 100%, how is an investor going to recover? I have no idea. Basically, cannot recover. Next stock is Citigroup. So we know Citibank and is licensed and all, but it has a history that was quite scary if you look at the price chart, right? So it has went up and then it has lost 85%. And until now, since 2008, it has not recovered. That's like what, 12 years coming to, yeah. So next is Wirecard. Now you may see this on your receipts worldwide. They process credit card payments and their stock price just have lost by 99%. How to recover, I also don't know. Basically dropped from $191 to 39 cents now. Next one is a local brand, Hyflux, infrastructure company in Singapore. At its peak, it was at 283, and now it's at 21 cents. So it's a 92% loss. Okay, how can an infrastructure water company suffer this kind of losses? I'm not privy to the information, but when we look at these losses, we have to remind ourselves about diversification. Okay, so again, bringing up the loss recovery table, just now the examples I've shared with you have suffered more than 80% to 90% losses. So in order for an investor to recover go back to zero, they had to make 400% to 900%. I think that is a very, very difficult thing to do, right? So what is the lesson here we can learn is that we must diversify. So how exactly do we do that, right? So to me, we need to form a football team. Okay, so we need to form a football team consisting of players of different strengths and different weaknesses. Is it going to be a winning team? I don't know, but we'll do our best. Okay, so how do I form? What is an example to form this football team? For example, your strikers, your offensive can be counters like SPY, QQQ, KWEB, or ARC. These are more volatile counters. So, but their gains are also quite phenomenal if the market cooperates, right? So in the midfield, you can have things that are a bit more defensive, things that are like consumer discretionary, healthcare, or utilities, right? And on the defensive side, you can consider things like bond, TLT, or even gold. So this as a team, I think it has a better chance of winning the game to help you make money and to help you preserve your portfolio. right? As the market come against you. Yeah. So let me move on. So this is very important. Like in many things in life, we need to have teamwork, right? To run this webinar, I can't do it alone. I have we have a whole team of people behind the scenes to make it happen. So teamwork is very important, even in your financial portfolio. So also borrowing the words of Harry Markowitz, he is a 1952 Nobel Prize winner, and he says that diversification is the only free lunch in finance. And I totally agree with him. If you read the recent news about High Flux and what's going to happen to them, there are so many retail investors that have lost their life savings in one counter. So if they have diversified their portfolio, then that they will create, it will have still created a dent, but it will not lose their whole life savings in one counter. All right, so let's learn from this and make sure that we are sufficiently diversified. So the third mistakes that I noticed I have made myself down through the years and also observe it among many of my friends is that we did not have a plan. Now, a plan is very, very important. Now, I believe that some of us who have traveled, we wouldn't travel to a foreign country for a tour without an itinerary, right? I mean, okay, some people may do that, but most people will not. They will plan in great detail, where to stay, where to go, every tiny detail, the subway of Japan and all things like this. But when it comes to finance, they just read an article or hearsay some tips and then they just go already. So I find that that's not the correct way of doing things, right? So in finance, I think it's very important. Now, losing money is very easy. Making money is very difficult, okay? So we must have a plan. So in trading or investing, we must know what is the counter we are buying, why we are buying it, the entry price, and the exit price, such as the cut loss or take profit, right? Or you want to trail your profit, also can. But at least you have a plan. Does it mean that the plan cannot change? No, it may change depending on the development of the market, but at least you start off having a plan and proper position sizing. That is for investing and trading, right? So also, if you plan to use third-party service providers, you also need to have a plan on how do you want to approach it, okay? So this having a plan, it encompasses every sense of this word. As the saying goes, if we fail to plan, we plan to fail. So I will also remind myself of this so that whenever anything comes along the way that looks really interesting, I must make sure that I embark it with a plan. All right. So with that, I feel that these three mistakes are the my big three that retail investors should avoid. And they are chasing shiny objects, they did not diversify enough, or they did not have a plan. Okay, so how do we overcome these three mistakes? Very simply, we need to ask better questions. So we can transform each of those mistakes into a better question. Then we ask ourselves, whenever something comes into our table, then we'll ask ourselves whether is this a shiny object and am I going to chase it? Right? And then we'll look at our portfolio now. You can look at your portfolio now and ask yourself, are you diversified enough? If any one of the counters or strategies were to get hit, are you having a catastrophic loss, or is it just a dent that you can recover from, right? By looking at the loss recovery table. And the last question that you need to ask yourself is that, what is my plan if I decide to embark on, or do I decide to take that trade or enter into the investment? What's my entry plan and my exit plan, right? Oftentimes when we read from the news and see the talking heads on TV, they will tell you when to enter, but they don't tell you when to exit. That's a common problem I find. Yeah. So and there's no reason for them to tell you, right? Because you don't give them you don't pay them. They are not your service provider. So we owe it to ourselves to make sure that we have our own plan whenever we enter into any trade or investments. Okay, so the key here is the way to overcome mistakes is to ask better questions. So the next better question that I'd like to ask, that I feel that we should ask ourselves is, how can we get started fast with less stress? I think this is the ideal, right? So we begin with the end in mind. How can we get started fast? So in my opinion, I would like to share with you what I did so that I can get started fast. Now, I have been trying to do my own investing and trading for many years, learning from many, many trainers, strategies, you name it. So, but it's still a very scary process if you need to start putting in real money and putting it in a sizable amount. So how can we overcome all this stress when you want to do investment or trading? Okay, so let me share with you how I overcome it. The first first thing that I tell myself is start with a chicken amount. So what do I mean by chicken amount? That means it's an amount that make you a chicken. It's so small that you won't be afraid to take that step, because procrastination and not investing is one of the worst things that can happen, because then you don't get the gain at all, right? So start off with an amount that you are comfortable with and just start, so that you are in the market. Okay, instead of having to analyze so many things, thinking that you're going to put your whole life savings into it, because you're not. You're just going to start with a chicken amount. So the second tip that I'd like to share with you is this saying that says time in the market is more important than timing the market. Now, for those of you who are in my community, you will know that I have done a webinar with Ritesh back in November 2020. And then I have started my Syfe investing back then. And later on, I'll share with you the performance of my portfolio with Syfe. And that is time in the market. After I opened the account, I put in the money, and I basically didn't have to do anything at all. And yet, Syfe is, okay, short of a better word, working for me, right? And I really appreciate the team behind Syfe to do that for the retail investors here in Singapore as well as worldwide. So instead of trying to time the market, just stay in the market so that you can get the gains instead of trying to time the market. So the third tip that I like to share with you is to let the expert do it, right? So if whenever we want to see doctor, we want to see preferably the best that we can afford, right? So likewise, when we do our finances, if are we the best person to execute the trade or the strategy? If we are not, there are two things we can do. We can learn how to do it, or we can find good people to do it for us. So if you're not the best person to do it, if you're not the expert, then find the expert that can do it. And there are many out there in the world, and Syfe is one of them. Okay, so because that's easier, yeah. So in my webinars, I also usually share this slide where I say that there are two paths to wealth. There's a DIY path, which is an active path where you are behind the wheel, driving the car to get you to your financial goals. So of course, you need to pass a license and get your experience, and then put in the effort to learn how to drive the car. Or you can also take the DFY way, which is the passive way to reach your destination, your financial goals, right? So your aim is to reach your financial goal. Whether you get there by driving yourself or someone drove you there, it doesn't really matter, isn't it? So is there one better than the other? In my opinion, no. Both are equally doable. And in the traditional days, for typical retail investor, we will probably need to do it ourselves, because nobody want to do it for us because our AUM is so low, right? But with technology, with fintech like Syfe, DFY has now become very accessible to retail investors, and I love it, at a very, very low fees. So we can both be drivers as well as passenger now. So we can do both. Okay. So with that, I have end my sharing about the mistakes that we retail investors should avoid. And I also share with you 3 tips on how to overcome the mistakes. Okay. So in my next segment, I'd like to share with you my portfolio that I have with Syfe. I did exactly what I shared with you, which is to start with a chicken amount. So I start something small so that I don't procrastinate and overanalyze and overthink the whole process. It's actually very simple. With people in Singapore, you use my info and you can onboard yourself in a matter of minutes or hours. And then I also take advantage of time in the market instead of trying to time the market. After the webinar with Syfe last year, I just start off and I decide to let them, the expert, to do it. And now I will share with you the portfolio. Okay, so I just want to have a quick disclaimer here. Past performance is not indicative of future performance, and you should seek professional advice before investing. And Syfe can provide you that advice if you need, because they are MAS licensed. Okay, so my Syfe soccer team is here. Okay, so over time they have grown their offerings to, in my opinion, allow us to construct the defensive, the offensive, as well as the midfielders in the person's financial soccer team. So the way I do it is that I use core growth and equity 100 to be on the offensive side. Of course, the volatility is higher, the drawdowns are higher, but the gains are also higher. Now, for the defensive side, I use a core defensive as well as REIT plus and cash plus, so that if I need to move the amounts up to defensive to the midfield or the offensive, I can do that easily because the money is already with Syfe. So in the midfield, I use core balance as well as global ARI. Now, this may or may not apply to you. This is just my portfolio and the way that I do it. So you can do it in whatever way you like. Okay, but please don't do all in just one side. Don't have all offensive or all defensive, because when the market turns or makes certain moves, your portfolio can be quite wobbly. So try to form a more balanced portfolio. All right. So what are the performance? So for my Syfe core have three different ones. This is the core defensive. Since I started in March, because it's a new product that they launched more recently, it has went up by 2.76%. You can see the roller coaster ride in the chart since March for core defensive. For core balance, my portfolio has grown by 4.32%. So the roller coaster ride of the equity curve, you can also see it there. And for the core growth, which is the offensive, it has grown by 5.37%. Now, all this without me lifting a finger, without me having to read any report, basically do nothing. I like it very much. All right, so this is Syfe core. And for my Syfe global ARI, which I started back in November last year, it has grown by 8.71%. And the equity curve is what you see there as well. And for my equity 100, since November as well, it has grown by 16.74%. Now, is it all straight line up? No, you can see that they are on my equity curve, there are ups and downs. But that's the nature of the market, right? Where got straight line up one? No such thing. So I have to say that I'm very happy with this performance. Now, is it going to be like that straight, continue on and on? Nobody can tell the future. But one thing I know is that I will stick in there, because I believe Syfe have a methodology and the expertise to continue to monitor the market, monitor the portfolio, to help us to manage our money well moving forward. All right. So I've just shared with you my Syfe soccer team. So I hope that this is some form of reference for you, for your consideration. Is this the only portfolio I have? The answer is no. I also do other things for my portfolio because I believe in diversification. So I also diversify into other strategies, other asset classes, and other service providers. So in summary, by all means, DIY, right? So while you're DIYing and it's very hard, why not also do some DFY? So that's my parting message to you. So with that, I'd like to check with you if you'd like to continue to monitor the performance from my Syfe portfolio. If you'd like to be kept posted of my Syfe portfolio performance, which I share with my community every month, please join my WealthEnjoy Telegram channel. It's not a chat group, so it won't be noisy. So by searching for WealthEnjoy in Telegram, and I'll be sharing my different wealth building education opportunities within the Telegram channel. So with that, I thank you for your time, and I'll hand over to Ritesh and take some questions if there is any. Thank you.
Yes, Richard. I think we have some questions. So before you jump off and hand the stage over to Ritesh, perhaps, I have two questions for you. I do think that our viewers, love the soccer team slide. So perhaps, we can actually rewind to that. Yeah.
There you go.
So I do think that it's really, really interesting. It makes things really easy for our viewers to understand. For yourself, is there actually like a percentage in terms of how you allocate between your offensive midfielders as well as your defensive? Yeah.
Wow. If you know trading and investing, then you can shift things around depending on certain market views, right? So but if you don't have, then I think that if you have a regular income, then by doing dollar cost averaging into all the portfolios is fine. So personally, I feel that when the market crash is when you need to deploy into the offensive. Right now, market is making all-time high, so may not want to allocate so much into the offensive. Yeah.
Understand. And maybe we can also take a look at the loss recovery table. I think there were a couple of questions around that.
Sure.
Yeah. So with regards to the loss recovery, right? For yourself, you mentioned that looking at if the drawdown becomes larger, the more you actually have to make back to break even. So for yourself, is there any psychological level until this level you will want to cut loss, for example? Yeah.
Okay. Generally speaking, if the investment amount is sizable, from I would say 20 to 30% is the max that a person should go. In fact, 20, yeah, correct. So if you're just betting a very small amount, then it doesn't matter, because that amount, even if you lose 100%, is not going to make you suffer in your everyday life, right? But if it's your life savings, it's your retirement funds, then I think the first two rows, I would say, is the max you should go, because to recover from there is still, within reach. Yeah, to go from the third row, fourth row onwards is very difficult.
Yeah, I do agree on that.
And I guess just to add on, last year was pretty interesting, right? If you just consider the COVID period of 2020, from February through March, right? If you consider even a broad-based index such as S&P 500, S&P 500 dropped by 34% from February to March, right? 34%. So essentially you needed a 50% recovery to go back to even, according to this, drawdown chart. And what that means is, these are typically the times where most of us panic, right? Once the markets are starting to lose 5%, 10%, I think right now when you're just seeing an upward trend, people are like, yes, I can bear a 20% loss, 30% loss. But when it actually happens, that's when we, see how people behave. And the observance that we, had at Syfe as well was people were running through the door as, the markets were coming off. And actually, that's the worst thing to do. Because if you are taking money off the table during these drawdowns, you are basically panicking and you're saying that, okay, I don't know where this will stop, so let me take my money out. But I think where people lose the battle is, the fact that then they wait for the market to recover. But by the time they're able to get in, the market has already recovered. That does not, wait for you. So it's very hard to time the bottom. And again, I think that goes back to the point that Richard was mentioning earlier. It's basically time in the market, then timing the market. And what that means is, essentially, if you don't think or you don't have the capacity to bear a 20, 30% drawdown, don't invest in those kind of portfolios, right? Make a solid foundation such that your portfolio drawdowns are limited to the threshold beyond which you will panic, right? So don't even, let it reach that panic button, right? And that will help you, make sure you ride through these ups and downs of the market in a much smoother manner. Because as again, Richard was mentioning, it is actually the end point that matters, right? You need to reach the goal. It is not that, how you sort of reach. I think how you reach is actually also important in the sense that, do you want a smoother ride there or do you want a volatile ride? If you are taking the volatile path to that journey, probably you might, end up chickening out, right? And that's, I think, the, pitfall of having those kind of, journeys attached to yourself. So do you want that much, pain for yourself? Do you want to have sleepless nights? Do you want to track the market on a day-to-day basis? Those are questions that you need to ask yourself. Are there better things for you to do than just chasing, these shiny objects, as Richard was mentioning?
Yeah. I do agree. I think also really to add on, right, is that with regards to the loss recovery table, right, it also acts as a very good check and balance, okay, to control our emotions when it comes to investing. So there was actually a viewer who was asking, how to control emotions. I do think that, this loss recovery makes things a lot more objective. Yeah, so just wondering if, Richard, you have anything, to add on besides this loss recovery. How do you actually manage your emotions?
Okay, I've been a DIY trader and investor for quite a number of years, right? Emotion is one of the toughest thing to manage.
Yeah.
And one of the easiest thing to do, okay, not that I'm trying to sell Syfe or anything like that, you can consider other service provider if you want to, is to let the expert do it. Right? So you take yourself out of the picture. You're diversifying away from yourself because you could be the biggest risk. So I would say back then, before robo-investors, before companies like Syfe, hedge funds are doing great. But they charge, and they won't even entertain retail investors. But thanks to technology, thanks to companies like Syfe, retail investors like us can go in with chicken amounts just to get our feet wet. Right. And then as we get more comfortable, as we understand the whole process more, then as we get more income from a job or business, then we can grow it through DCA or, annual contribution, and let the expert do it. Diversify away from yourself because you are not the expert. I'm not saying you cannot be the expert. I'm saying it will take time for you to become an expert. So while you're clocking your experience and to become an expert, why not DFY? Let someone else do it first, right? And the beautiful thing about companies like Syfe is that every transaction, every move that they make is totally transparent. In your portal, in your client portal, you can see every trade that they make, every ETF where they buy and sell, all the rebalances, they will keep you posted. You can also learn from why they are doing it and how they are doing it, right? So it's like having a co-pilot. It's like when you're learning driving, you're L plate driver, you still have your instructor next to you. So while you're still learning to become a driver. Yeah. So I think one of the ways that people can do now, retail investors can do now, is to do DFY because it has come to a level where retail investors can participate in that at a very low fees. Later on, I think you can, Ritesh will share with you how much Syfe charges. It's ridiculous. Sorry, not ridiculous. Right? I mean, for hedge funds, it's charging like 2% or 20% high watermark and stuff like that. But Syfe is charging like 0 point something. I mean, please don't raise prices.
Right. Okay, cool. Thanks for leading to this. I think, we can move on to the next section whereby Ritesh will be sharing a little bit more with regards to Syfe offerings as well as like the pricing is definitely attractive as what Richard mentioned. And, we can continue from there.
Okay. Thank you.
Awesome. All right. So let me share my screen then. If Vivian could help me give access. All right, great. So, okay. I hope you guys are able to see my screen now. Jaswin?
Yes, we can.
All right, great. So I guess, it was very well covered by Richard about all the pitfalls that encompass investing and investors in general as well, right? Like, when it comes to concentration risk, when it comes to, shiny objects and chasing of those shiny objects. And especially, I think, over the last 1 year, there has just been a massive retail participation into the investment world. And that has really led to, some of these, new age phenomena like, GameStop and AMC and the likes, where, stock prices suddenly skyrocket because, there is a social media group where everyone, says that let's, get into this. But I think as Richard mentioned, there is no, get rich quick, formula. Everything that goes up by that percentage, there will be a time that they will fall. And typically what happens is, by the time you know about something and it is going up and you start to participate, it is probably time for it to already come down, right? So it's very important to keep those emotions and biases in check. And that's what I think Syfe as a platform tries to achieve for you, right? So I think Syfe is about democratizing finance. It is about everyone getting access to high quality institutional investments and at a fraction of the cost that is typically available to most of the retail clients to begin with. I mean, even right now, when you go to like a big bank, you go to a financial advisory firm, they will typically ask you, entry fee, exit fee. They will, have a, management fee, which is like 1 to 2%. They will typically, put you into strategies which are either, say, underlying products are very high management fee and they get kickbacks from them, or there are, insurance products and all where, again, it is more about, getting commissions rather than trying to solve your problem. So I guess, that combined with the fact that there has just been an explosion of options available in the market where, if you want to do something, there are just so many things available. It is actually already very confusing where to get started. And I think that's where a lot of people are not able to move forward. They know, like most of us know, that we need to do something about our money, and money lying in the bank is definitely losing money. But because of the plethora of options available, oftentimes it becomes a little tough for us to think through in a planned manner how to go about starting our investment journey. So I guess Syfe is a platform. We are a digital wealth manager. What that means is we are digital first. We build our products to scale. We use passive investment strategies in terms of building blocks. So we only use ETFs in our portfolios so that, from a cost standpoint, they are kept minimal. What we have found by doing research and, data that has been, available for everyone to see is that 90% of active managers, they end up underperforming the relevant indices or the benchmarks that they're trying to beat over the long term. So our philosophy is that why do you want to, sort of pay for actively managed strategies when you can achieve the same or better using passively managed ETFs, for example. So I think overall, the idea of Syfe is really to democratize investments for everyone, give you access to high quality, investment portfolios, and at the same time, help you invest in a very goal-oriented, planned manner as well, right? Like that's what I think is missing right now when you're thinking about investing, but you don't know where to get started. Now, quick peek into our history and team. Syfe was started off in 2017. So we are a local Singapore headquartered company. We got our license, which is called the CMS license from MAS. So MAS is a local Singapore regulatory body. This is an extremely stringent license to get, something that is given only to people who have previously managed money for I think big institutions, and that is something that you can see as part of our team structure and all as well. Very high pedigree in terms of who these people are, as well as the experience that they have working in big banks, hedge funds, and also academia, right? For example, Dhruv was a portfolio trader at UBS. Richard, he's a 30+ year veteran in the financial services industry. He's also previously adjunct professor of portfolio management and risk at NUS Business School. So he sort of combines the academia with the professional world, and he's done that for decades and decades, right? And Akiko, who is our rocket scientist, in my opinion, so she is PhD, and she's the actual quant behind all our strategies. And again, other folks as well, Sebastian, Lawrence, myself, who come with different kind of experiences, and each of them, help us build strategies that can help our investors invest in a more goal-oriented manner and all. Now, in terms of just to give you a little bit better perspective about our license, we have a retail fund management license. This license basically means that there are very stringent procedures that are put in place when it comes to the Monetary Authority of Singapore in terms of how we manage your money, right? And when you're looking at the retail fund management license, it allows us to manage money for retail as well as institutional clients. So it's a broad umbrella of clients that we can manage money for, and usually the regulatory body is very, very strict when it comes to managing retail money, right? Because essentially they would be very, very, conscious if an average person on the street loses money versus a person who's already very high net worth, they losing a fraction of their wealth, right? Because most of the people, they have, earnings that is, on a month-to-month basis. And if you lose a significant chunk, it can be quite strenuous. How does that get taken care of? As part of the license, we are required to keep client assets and client monies completely separate from Syfe's own money and our own assets. So when you transfer funds to us, they are kept in, first they go into a DBS trust account. And from there on, when we buy securities on your behalf, those securities are held in custody with Citibank and HSBC. And our own assets and funds are kept completely separate in a completely different bank account. And what that essentially means is, in a worst case scenario, like God forbid, something happens to Syfe as a company, because of this structure, we will be required by law to, make sure that we give all clients all their assets in full and redeem them in full as well, right? Because we are not allowed to touch client assets. We are only allowed to use client assets to buy and sell securities on their behalf, right? So it's a very, very important aspect to note that, because of this license, your monies and your assets are kept safeguarded with us. Now, quickly coming on to the portfolio offerings, I think what is more important here is not just the actual implementations, but the thought process of how we think about, constructing our portfolios. And to that extent, essentially, if you think about money, roughly you can bucket your money into 3 different segments. Money that you want to keep safe and sound, that is your liquid savings account, right? Typically, you keep that money in your bank. You want it to be, super safe. You don't want to take any risk with it. But at the same time, you want to maximize the interest that you, generate on that cash, right? Because this is money, that's just sitting idle. So typically emergency funds and the likes, or, something, a very short-term goal that need to be addressed, such as, say you want to purchase a house and there is a down payment to be made in 6 months, you would potentially not want to take too much risk with that kind of money. So that's where I think, typically the savings aspect of your money comes into play. The second bucket is income bucket, where essentially you want to generate a regular cash flow with your assets. Typically, these strategies or investments that cater to this is like fixed income, bonds, those kind of strategies. We have a differentiated strategy that we will talk about in more detail later on as well. And the last bucket is your growth bucket. So this is a bucket where you want to really, generate returns and appreciate the value of your wealth, right? So essentially, capital appreciation is the, bigger problem that you're trying to solve, rather than cash flows on a more immediate basis. And typically these long-term, this particular growth bucket caters to some of the long-term goals that you have. So typically, if you're thinking about retirement planning, if you're thinking about, say, children's education, financial independence, all of these, or, say, starting your own business, like, these are long-term or medium-term goals. And for them, you want to make your capital appreciate over time such that you can, get to a lump sum amount to sort of cater to the cost of that particular goal, right? So now, in terms of Syfe, what we have done is we have consciously thought about these buckets when it comes to investments, such that from a client standpoint, it becomes very, very simple. You know what purpose your investments are meant for. Like, what is the role that each of your investment is trying to solve for you. And I think similar to how Richard, previously presented the whole football field kind of, arrangement when it comes to portfolios and, like, how do you choose different portfolios for different, places. We also have a framework that can also gel well with that approach. And that's something that I'll cover in the next slide. But, let me give a quick peek into the portfolios that we have to cater to each of these buckets. So on the savings bucket, we have a cash plus portfolio. It is implemented using money market and short duration bond funds. It currently projects to give, I think the number is, not updated here. So it's 1.5% returns projected at this point of time. There are no lockups, there are no limits, there are no gimmicks associated with this, particular offering. Now it is not an exact sort of, replica of a savings account, though. That is something that you need to note. It is a portfolio with very, very low risk. What that means is essentially, because we are investing into money market and short duration bond funds, the portfolio will have some movement on a day-to-day basis. Most of the days it will have a positive movement, but there could be occasional days where there can be a slight negative movement as well. But essentially, if you are ready to keep your cash for at least 1 month, that's the way I think about our cash plus portfolio. If you have a time horizon of at least 1 month plus, that's where I think the cash plus portfolio will give you a much better return than money sitting in the bank, because, the bank interest rates are at all-time lows right now. And keeping too much cash sitting in the bank will essentially erode your capital per se, right? So definitely something for you to consider, maybe part of your emergency funds, maybe part of, the upcoming house purchase that you're planning to do, or even if you want to, allocate funds to our other investment portfolios, but you don't want to, put it all at one go, you can do recurring transfer from this cash portfolio to all the other portfolios at no extra cost, right? So, again, this is a free portfolio that we offer to our clients. So definitely give it a try. It's a portfolio, I think, that has worked very well for a lot of our clients. Coming to the income bucket, we have not implemented a pure income portfolio. We have implemented a portfolio which gives you a sort of a combination of income and growth. So REITs is our, REIT Plus is a portfolio which basically combines, the aspects of income and growth. The reason it is able to do that is because fundamentally REITs are structured such that 90% of their income are required to be given away as dividends to shareholders. And what that means is you generate a very high dividend yield of 4.5% through your REIT investments. And also REITs are listed on the stock exchange. So they have attributes of both fixed income as well as stocks because they're listed on the stock exchange. And because of that, their price do fluctuate over time. And over time, as the economy grows, as real estate prices grow, the REITs are expected to generate you return, not just in terms of dividend yield, but also in capital appreciation. So I think this is an extremely popular portfolio on our platform as well. And this is relevant for both younger as well as older investors. Younger investors tend to reinvest their dividend back to the portfolio and use it as an actual growth portfolio. And older investors, they tend to use it more as an income portfolio without having to draw down from their principal per se, right? So they will take out the dividends and let the principal grow at a smaller pace per se. So that's, I think, the REITs portfolio and the job that it is supposed to do. The last bucket is your growth bucket. And as I covered earlier, if you have medium long-term goals, you typically need an equity-based strategy because equities are the asset class that helps you grow your capital. Now, within the growth bucket, I think what is more important for you to think about is time horizon and your personal risk appetite. I think these are things that, again, Richard covered very well when it comes to drawdown risks and stuff like that. You need to understand where your drawdown, threshold is, and then accordingly choose a portfolio that can, sort of remain within that threshold per se, right? So in our case, we have, our core portfolios, which is from defensive, balanced, growth, and then we have an equity 100 portfolio. And the risk basically increases as you go from left to right. The core portfolios are a mix of equity, bond, and gold. So, fairly diversified across asset classes, across geography, across sectors. Defensive is 20% equity. So, predominantly bond and gold heavy. So, very, very conservative in nature. Balanced is 40% equity. So somewhere in the middle, as again, Richard was covering from his football field kind of depiction. Defensive will be, at the back. Balanced will be somewhere in the middle. Growth will be from middle to, forward as well. So growth is 70% equity. And then equity 100 is 100% equity portfolio, right? Now, I mean, I do have some numbers in terms of these portfolios when it comes to drawdown risk. Defensive portfolio, if I'm not mistaken, last year, or, when you think about, max drawdown, defensive portfolio is roughly around 9% drawdown risk. Balanced is around 13% drawdown risk. Growth is around 19% drawdown risk. And, equity 100 can be anywhere between 25 to 30% drawdown risk, right? Because, again, this is a pure equity portfolio. And so it will be a little bit more volatile from that standpoint. But again, I think the more important aspect of this slide, and the reason I spent so much time on this slide is to emphasize that once you can map these three different buckets of savings, income, and growth, and then within that, if you can identify what's your investment time horizon, what's your risk appetite, then it becomes a little bit easier for you to then design your own portfolio, right? Like you don't really need a lot of hand-holding per se. Once you have the framework, you can already go ahead and implement it. Now, again, I think I also wanted to depict a potential sort of a case study where, similar to Richard, there is a little different way for you to also think about your investments. And this takes into account your objectives, right? Like, goal-oriented investment is what, we are trying to do. But at the same time, what we are also trying to, inculcate is this framework of core and satellite investing, right? And I think it, in a way, gels very well with the example of the football field. The core is sort of your foundation, where you invest according to your risk appetite, according to your goals, according to what you're trying to solve for. And your satellites are where you are taking specific risks, where you have a view on, or you want high growth, or you are trying to solve for a very specific purpose per se, right? So in our this core and satellite framework, what it means is if you just concentrate maybe on the retirement goal, even within retirement goal, you can have your foundation based on a core portfolio because it's a diversified portfolio across asset classes, equity, bond, and gold. Now, whether it is core growth or core balance really depends on your personal risk appetite. But the idea is it should be a diversified portfolio. And then I think you do have some exposure to equity 100 and REITs here as well as satellite strategies. So, in Richard's case, it was like the forward. In our case, it is like a satellite, right? So, but, the idea is basically the same, that you want to put bulk of your investments into a portfolio, which is, sort of aligned to your risk appetite, aligned to your investment time horizon. But at the same time, you do want some exposure to high growth opportunities. And that's where I think an equity 100 or even your single stocks and other, kind of portfolios can help you get that kind of, views incorporated, right? And the point here is, build a solid foundation, have bulk of your money, invested in that format, which is very, very diversified. So again, diversification is the only free lunch. So concentrate on building a strong foundation. Once you have a strong foundation, then having these satellite strategies can actually help you navigate through the ups and downs in a much more smoother manner, right? So I think this is what this slide tries to depict. And again, if you have more detailed question in terms of individual goals and how to solve for it, we do have on Syfe dedicated wealth experts. So on our website, there is a way to connect with us. We do offer free consultations, so do engage with us. And accordingly, we can think of how to cater to your specific objectives as well. So very easy to get yourself onboarded. We are available both on the Apple App Store and the Google Play Store. It's literally, if you're onboarding through My Info, it's literally 3 to 5 minutes that you need to get yourself up and started. Everything is transparent. Even before you create your account, you can actually see all your portfolio in full, the components, the underliers, and the projected returns, and all of those can be calculated. I think it's very useful to do that analysis in terms of planning your investments and what goal value you're trying to achieve. Once you invest, everything is shown very transparently to you in terms of values, in terms of transactions, dividends, fees. Everything is shown for you to look at. I think this is a slide for you to just understand that we as a platform do not have any minimum, so you can get started at any amount that you are comfortable with. But as you invest more, the cost of your investment keeps coming down, and that's a benefit that you get as a platform. We also want to achieve scale, and what that means is the more you invest, more of those cost benefits we will actually pass on to you as well, right? So it starts at 0.65%, but goes all the way to 0.35% if you are investing north of $500,000 and above. And as I said earlier, all our clients, whether you're blue, black, gold, or private wealth, you do get access to our wealth experts. And so do utilize us and do speak to us to get a better perspective about our portfolios and how they can cater to the different goals that you have in mind as well. Very important to also note that while we do charge some fees, I think this is sort of in a way covers a lot of aspects. It covers all the implicit costs that you will have in terms of thinking about what to buy, how much to buy, how to rebalance all of those. But at the same time, more explicit costs are also covered through our platform because we don't have any trading fee, we don't have any entry or exit fee, there is no minimum balance to be maintained. There is no lock-in of your money. You can just take your money out whenever you need. We do, want investors to invest with a long-term time horizon. But if, you do have an emergency and you need to take your money out, you can. All the rebalancings are done free of cost. Dividends are automatically reinvested. You can switch between portfolios, without any extra cost as well, right? So all of these are taken care of for you. This is just like a quick comparison of using Syfe, and this again covers more of the explicit costs that we were talking about. But even more than this, I think the bigger cost to me is just the time that I need to do when I'm trying to do everything by myself. And as I covered earlier, we have a pretty strong team of wealth experts. So do engage us. If you want to reach out to us, there is a link on our website. It's called Wealth Experts. Just go there, schedule a free consultation call with us, and we'll be happy to, answer all your queries. Also, there are upcoming webinars. We just gave a very, high-level overview of our investment portfolios in today's session. But if you want to get a little bit deeper, please join in this session in a week's time. So this is 1st of July, led by Sebastian Sieber. And just to conclude, because we are having this webinar with WealthEnjoy, there is a small promo that we are giving away for all the participants who have taken time off to participate in today's webinar. So please do use this promo code if you want to get started, and depending on how much you're putting in, there is a token of appreciation and promo bonus attached to the different amounts that you deposit. And with that, I think we are at the end of the webinar. I guess we are ready to take a few questions. Joshua, I think we are already at 8, but maybe a couple of questions to wrap it up.
Yeah, thanks for that. Yeah, currently, I think, we just have 3 questions. So maybe, we can start off with the first one, and Richard can actually weigh in on this. So there are several viewers who are actually asking with regards to the differences in terms of the robo-advisors. So, maybe Ritesh can shed some light, as well as Richard, if let's say, you have any experience with them as well.
Sure. Richard, do you want to take this first as a neutral?
You have to be more objective, right?
Objective, okay.
Yeah, correct. We need an objective opinion.
Okay. Okay. Personally, I'm with multiple robos, right? Because that is in line with diversification. Yeah. So different robos have different strengths and weaknesses. So not all robos are the same, and not all robos are robos. So you need to do your research on the robos and then proceed accordingly. So I feel that in the theme of diversification, also don't put all your egg in one basket. Don't put all your wealth in Syfe. Do spread it out. Do spread out to different asset classes as well. If you like to dip your toe into crypto, by all means, put a small tiny bit there to see whether it go to the moon. And if it go to 0 instead, make sure that it doesn't hurt you. All right, or hurt you badly. So different asset classes can be also in properties or other things, So yeah, so I'm okay to diversify into multiple robos, and I'm doing that.
Right. Thanks, Richard. So I think generally, as Richard has also pointed out, it's never a bad idea to diversify, and do look out for if there is some specific aspect that a particular robo solves for you, which which is not sort of taken care of on a more holistic basis. You can definitely try out the different platforms. I think from a Syte standpoint, I think we pride ourselves in terms of having a very goal-oriented portfolio construction process, so that it makes it our intent is to make it super easy, super transparent, super convenient for our investors to start investing. There is, as I said, no minimum for our investors to get started. You can, I think the biggest sort of reason why people are not able to sort of action their investments is the fact that typically when you go to say brokerage platforms or other platforms, there are minimums attached, and there are at every point there are transaction fees and all. So I think we pride ourselves in having very transparent fee structures, and the fact that we don't have any minimum, even if you say have a monthly contribution, and if you're someone who's just started working, it's never a bad idea to just keep investing your small bits and pieces, because every dollar counts in the long run. So I think the bigger aspect to think about is, start investing early rather than waiting. So that's the important aspect that we try to solve for. I think in terms of differentiation, one more aspect is, some of our portfolios are very, very unique in terms of the specific goals that they try to cater to. When you look at, our REITs portfolio, I think the way that it is designed is very, very innovative, very creative. And you get access to the direct REIT underliers. So it's, not a 2-layered fee where you pay for, pay our management fee, and then you also pay for the ETFs underneath per se, right? And REIT ETFs tend to be very, very high cost compared to, the broad-based equity, bond, and those kind of ETFs, which are very, very low cost in nature. And I think the aspect that we do have a proper wealth expert team. It's not just like, a robot managing your assets. I think it is, not the case that it's a digital platform so that means, there is no one home. We are always available to your service, and you're getting served with, some of the brightest people around, people from, Citibank, DBS, UBS, myself, Goldman. And that I think is, something that is unheard of at the kind of cost that is, you're paying per se, right? So I think these are very important attributes of Syfe as a platform, and we are continuously innovating and bringing you more, palatable solutions. So do keep a lookout, and we will continue to, get ourselves better.
Sure. Okay, maybe just one last question before we end off this session. So a viewer actually, highlighted that there seems to be a time lag from the time whereby he or she put in the money to where he see the money appear in the dashboard. So maybe you can help to clarify on that.
Sure. So actually, there is a cutoff. So any day when you are transferring funds to Syfe, if you transfer the funds before 11 a.m., then your funds actually do get invested on the same day, right? While you might not see the funds and the underliers on the same day, because we will need to trade with those funds to buy securities, and once we buy those securities, you will be able to see those positions on the next day. And typically, we run our NAV calculations at around 2 to 3 p.m. So it might feel like you are seeing the investment holdings after 1 day or after 2 days. If you miss the cutoff, then essentially we'll buy on the next day, right? So it can feel 1 or 2 days, but actually, like if you are able to meet the cutoff of 11 a.m., your money will get invested on the same day. Similarly, if you withdraw the funds before 11 a.m., if you give the request to withdraw before 11 a.m., then the buying or selling will happen on that day's prices, basically.
Sure, thanks for the clarification. So I think with that, we have come to the end of today's session. I really hope that, this session have given our viewers a better idea in terms of, what are some of the common pitfalls and how to avoid them, as well as how Syfe's portfolio can actually set as a foundation, to their investment plan. So with that, really thank you so much for joining us this evening, especially to Richard for the sharing. It's really our pleasure to have this session together. Anything to add from your end, Richard?
No,
Okay.
Get started with chicken and mouse.
Yeah. Okay, cool. So to the rest of our viewers, really we look forward to your continued support and trust, and have a restful evening, everybody. See you.
Thanks, everyone. Thanks, Richard.
Thank you.
Bye.
Good night. Bye-bye.